Support Chicagoland causes close to your heart.
Yeah, we got a lot of those to talk about on the show today and throughout the day here at WGN Radio. One of them will be an organization called Toy Box Connection. You'll hear about that in the next half hour. Toy Box Connection, a good way to donate any extra funds you have to a cause that maybe you don't know about. We'll talk about that in a little while. John Bever joins us right now, the financial advisor at Phase 3 Advisory Services. Speaking of the holidays, let's talk about holiday spending and the economy in general. Is there a seasonal rally, and is it on? Welcome back to the show.
Thanks. It's good to be here on this Giving Tuesday. So here's the scoop. Yes, we are in the holiday rally, sometimes called the Santa Claus rally. Maybe today we're taking a little bit of pause, but it's been pretty good. The holiday retail sales were okay. I wouldn't say that they were great, but they were okay. We had over 200 million people that shopped over the weekend. But MasterCard, it's interesting. They showed Black Friday sales rose 2.5%, but over the last year, personal consumption, that index of inflation was up 3.5%. So unless spending was up 3.5% from a year ago, spending on an inflation-adjusted basis was actually down. But Cyber Monday, record sales, so we're not done yet getting those numbers in, but the market seems to be fairly happy with this. Oil is down. That means that people have more money in their pocket to spend for the holidays. And it looks like maybe some stock market breadth is coming back. So yeah, we're expecting this Santa Claus rally to continue on into the end of the year.
Do we want people to continue to spend money? Do we want people to spend a lot of money?
Not really, especially as a financial advisor. You know, we try to help people save more money. We kind of have a spending problem in this country, not only with individuals, but also with the government. Maybe we can talk about that in a little bit. But I want to put this in here. The best financial principle, the thing that I see among my clients that is number one, and those that are most satisfied with their finances actually are those that have a regular way of giving. Giving Tuesday just ties into that. It's a really important principle about generosity. Not what we were going to talk about, but I just needed to say that on this Giving Tuesday.
Yeah. And it's interesting, too, because you sort of went in a direction that I didn't entirely anticipate. When I said, is it good for people to be spending money, you made it a personal level issue. In general, is it good for the U.S. or the economy if people are spending a lot of money? Is it not true that if we all continue to spend money, then inflation isn't going to go down as quickly as we want?
That is part of the issue, but where inflation comes in at its root cause is really when you have excess money in the system. Not people spending more money, but more money in the system, and that comes from Federal Reserve quantitative easing, taking printed money from the Treasury and putting it into the banking system, and when the government spends money it doesn't have, in other words, borrowing money. That's really at the root cause of inflation. So people spending money, yes, that's a good thing for the economy. They need to balance that personally with their own budget. You have to have that balance between spending what you need to, but also saving what you need to, which long term is the best thing for the economy, to have healthy consumers with good savings.
Right, because if nothing else, my personal finances notwithstanding, if I'm shopping, that's good for all of the stores I shop from.
This is true. That's good for the employees in those stores.
Yeah.
It's good for everybody that manufactures those products, yes.
So then when the Fed looks at the rosy picture that you're painting, I wonder what they think.
They still have to fight inflation because the root cause of inflation hasn't gone away. They made it very clear. They're going to get to 2% inflation, and we're not there. We may feel like we're close because we've come down from 9% inflation to maybe 3.6, 3.7%, but it's still a long way from 3.7 to 2. Yeah. That's the hard part of the journey. We made the easy part of the journey.
But, John, I know I've asked this to you and a number of others, and I guess I'm not smart enough to remember or fully understand the answer. How significant is 2? Like, what if they had said 2.5 or 3? Is there something magical about 2 that 2.9 or 2.8 does not accomplish?
Personally, I don't think so. I think there's something else that's at play here. If they shoot for 2 and get to 2, maybe they'll eventually get 2.5. I think that they didn't want to message at 3. They wanted to message at 2. But I think below the surface of all this is something that's not being talked about, that needs to be talked about, and that is the extreme cost of our government debt and the interest cost. Mm-hmm. The higher the inflation rate, the higher the interest cost on that government debt. The lower the inflation rate, the lower the interest cost on that government debt. You know, this next year, over the next 12 months, there's over $7.5 trillion. That's a T, $7.5 trillion of government debt that has to be refinanced, and it's going to be refinanced at a higher interest rate. So they need to get the rates down. The only way to get the rates down is to get inflation down. So they've got the rates up right now to slow the economy so they can get inflation down so they can get those rates back down again. I think that's actually what's at the core of the 2% inflation.
What sets that rate then? I don't know if that question makes sense, but okay, I'm rooting for a lower number there. What determines that necessarily?
The inflation rate?
Yeah. Well, or the interest rate that you're talking about.
So the interest rate that I'm talking about is actually set by the market. The Federal Reserve sets short-term interest rates. That's the lending rate between banks, in essence. And then from there, the market kind of figures out where it wants the rates to be. Today, we had a Treasury auction yesterday and today, and actually the rates were down a little bit, which was nice because there was a lot of borrowing, but the rates were down a little bit. But that rate is ultimately set by the market, and the market looks at the inflation rate. So when the market looks at the inflation rate going up, the market wants to, get a higher return on bonds. When the inflation rate is coming down or a low interest rate, they don't require as much. Remember, we came off of a very low 1.5% 10-year Treasury bond just a little over a year ago because the assumption was rates were still going to stay low for a little bit. Maybe inflation was going to stay low. We're in a much more normal environment right now. And right now, the market isn't anticipating 2% inflation, but it looks like the market is anticipating just below 3% inflation based on projections on what might happen to interest rates next year.
I want you to talk about bonds a little bit, and also just as a listener reviews their allocation of their assets, maybe they were 60-40. Bonds weren't necessarily the perfect counterbalance to stocks this year anyway. So talk about bonds, talk about allocation. How should our retirement portfolios look generally? Let's pick it up here in just a minute. With John Bever, he's the president of Phase 3 Advisory Services, a registered investment advisory firm and registered principal with Osaic Wealth, Inc. It's 12:43. More business news now. It's 12:50 on WGN. This is the Wintrust Business Lunch. Right now we're talking to John Bever, president of Phase 3 Advisory Services. John, you were just mentioning hey, John, you were mentioning bonds.
Yep.
I'm going to ask you to talk about that in 30 seconds. First, let me say this. Today is Giving Tuesday. Marquette Bank wants to remind you to support local nonprofits and organizations in your community like the Greater Chicago Food Depository. Listen to WGN Radio all day today and visit emarquettebank.com/give to join with Marquette Bank to support local causes. Remember, because you choose to bank with Marquette Bank, good things happen in our neighborhoods. Marquette Bank, member FDIC, equal housing lender, love where you bank. John, what about bonds? They were kind of weird this year, right?
Not a good year for bonds, and this follows the worst year ever for bonds in 2022. The average bond was down 13% in 2022. Worst year ever since we started with the bond market, 1789. Alexander Hamilton issuing the first treasury bond. So it was brutal last year, bad this year. When we looked at the numbers, September 30th, the aggregate bond index was down 5%. That was on the price. And again, not bad, not good. That's, a pretty bad year. So 2 years back to back, that means next year could actually be very good. So number one rule, diversify. Diversification is not dead. We've seen times like this before where the only thing seemed to be working was the S&P 500, but bonds are a great recession hedge. We might have one still next year. We still think it's in the hopper. So don't forget to have bonds in your portfolio.
If your portfolio has lagged the S&P 500, what do you think about that?
That would be typical. That would be expected because this year, the S&P 500, the one that's quoted is a cap-weighted index. That means that each company gets a slice of the pie based on how big they are. So the largest 35 companies out of 500 make up half the index. The other 465 make up the other half. And get this, the top 7 companies, called the Magnificent 7 or Fab 7, Those 7 make up a quarter of the index, and the number one performing stock this year in the top 7, actually in the top 4, NVIDIA, up 227%. That drove 1/3 of the return in the S&P 500 so far. If you equal weight that index, meaning that each company gets an equal slice of the pie, the index is only up a couple percent at this point in time. So don't be discouraged if your portfolio is down on the year a little bit, flat on the year, up a couple percent. When you look at your September 30th statement, it actually might be down a little bit. Don't get discouraged. Stay diversified. That means make sure you've got small and mid-cap funds in there, international in there, and by all means, make sure you have bonds, again, based on your risk tolerance and how much volatility and time frame. Work with your advisor on that. But don't give up on the rest of the market. It's not all about just the S&P 500.
But if I'm in an index fund that's charting the S&P 500, is the allocation of those dollars of mine into that fund weighted the way you just described? Did most of my money go to that chip maker as opposed to the other 465 companies?
Absolutely. In fact, the vast majority of 401k, 457, 403b plans that use an S&P 500 index fund is, in fact, the cap-weighted index, not the equal weight index.
Right.
If you want to get the equal weight index, just do a Google search, and you'll see some of them that are out there.
But I don't know if I want to do that. Maybe it's better to just go with the weighted one. Is that what you're telling me?
No, I don't think it is. In fact, this divergence between the cap weighted and the equal weight, we only see a couple of times, and it's not good news when we see it. It usually precedes a bit of a bad market. So I'm not saying we're going to have a bad market, but definitely you want to make sure that you are moving away from that cap weighted more to an equal weighted.
But I'm sorry, didn't you just say though that in fact those few stocks that did well are the ones that lifted the entire index? The cap weighted, those heavier weighted stocks lifted the S&P 500, right?
Yes, they did. And so if they start to stall out in their performance and the other 465 start to play catch up, and you're in the cap weighted index, you're not going to be playing catch up as if you were in an equal weighted index.
Okay, but this is almost like market timing, it sounds like. So what's going to happen in the next 6, 12, 18 months? What's going to happen?
No, this is actually buying what's inexpensive, buying what's on sale. You know, former president of Oppenheimer Funds, he used to invest this way. He said, I look at the 401k fund lineup, and I look at which funds did the worst last year, and that's where I put my money in for the next year. Now, I wouldn't recommend going to that extreme, but the idea is this. You don't want to buy what's already run up and what's expensive. You want to buy what's cheap. You have to wait a little while. That's why investing in stocks is not a 3-year deal. It's really a 10-year deal.
What's your thought about 60-40? Is there some magical balance number? I know it depends on your time horizon and your age, but can you just talk about stocks to bonds ratio-wise?
Yeah, generally so. It was, the last 10 years, the 60-40 didn't do so well. The bonds made a little bit of money on the way down, but now on this way up, they've really gotten crushed in the last 3-4 years. So the deal is this. You need to have bonds in your portfolio, but you need to look at those based on the time frame of when you're going to use your money, not even based on your age, but based on when you're going to use the money. And the closer you are to needing that money, the higher percentage you need to have in bonds. So if you're still 30 years away from needing the money, the 60-40 is not probably the appropriate allocation for you. You want to have less than 40% in that bond allocation.
John Bever, financial advisor, Phase 3 Advisory Services. Phase3advisory.com is his website. Really interesting, John. Thanks for the insight and thoughts today.
Glad to be with you.
WGN Radio News in the Northwestern Medicine Newsroom is next.
Pain and tingling in your hand wakes you up at night. You move.